Hey, checking in with a few market updates. There's a couple things I want to touch on today. So, number one is really just a quick review of 2023. It was a great year. The S&P 500 was up over 26%. Would you believe that 90% of that return ended up being attributable to those top 7 stocks? So it's that Magnificent Seven, as they're being called. Those tech giants out there really led the way. The other 493 stocks combined only attributed less than 2% of that 26% return. So that's incredible. Let's hope we see some more momentum, more participation in 2024. And also, let's hope that those stocks can keep up what they're doing. So number two is, where are we with the Fed? So remember, market interest rates don't move when the Fed changes rates. They mostly move when the perception of what the Fed is going to do changes. So right now, the market is pricing in 5 to 6 rate cuts in 2024. That's down from the 7 that it had been pricing in, believe it or not. They did decide last week to pause, as anticipated. Their announcement also reiterated their clear commitment to hitting that inflation target of 2%. So the December number came out at 3.4%. Remember, it went from 9 down to 3 pretty quickly, in about 12 months. And then it's kind of plateaued here in the 3 to 3.5% range. So we still do have some work to do. There is a good chance, though, that market rates come up before they eventually do come down. So wait and see what happens there. In terms of the economy, most economists have relaxed their recession predictions a little bit. It's still a possibility in 2024, and particularly if rates don't come down soon. However, things have been pretty good, even with rates as high as they have been, as long as they have been. So the training wheels are off at this point. And in the third quarter, we saw GDP growth at 4.9%. That's a really strong number. It was 3.3% in the fourth quarter. We'll take it. Remember, those are real numbers. So that's net of inflation. The nominal numbers were more like 7 to 8%. So pretty solid. The economy is growing. Third thing I want to touch on was new addition to the portfolio. And it's kind of a unique asset class. Most investors know that municipal bonds are great. They offer the benefit of being tax-free. But did you know there's also a growing presence of taxable municipal bonds? So that market is mostly dominated by institutional money, which is, traditionally a lot more disciplined than retail investors, individual investors. You just don't see the same kind of knee-jerk reactions with pensions and endowments and insurance companies. So in general, it's a lot less volatile than municipal bonds, tax-free municipal bonds, I should say, which are about 70% individual investors by contrast. But what we're doing is it acts a lot like the traditional U.S. aggregate bond index. It's got really high credit quality, about AA average, which is really good. It's got a slightly higher coupon than the ag and really comparable duration. So we're not taking on more interest rate risk necessarily. And the asset class does have a slightly lower correlation to equities, which we like. So the goal here is really just a way to get more safe, boring bond returns without investing directly into the federal government, like treasuries and agencies. We are also reducing our exposure to alternative investments as a whole. So we like the momentum of stocks. We like the valuation of bonds. Kind of makes sense to just kind of lean into those two things and really back away from alternatives. Alternatives were really there to help us in 2020 during COVID. And then again in 2022, they helped buoy those downside periods. But right now, we just feel more comfortable with where bonds are and also equities. So that's what's going on here. Let us know if you have any thoughts or questions. We'd love to hear from you. Thanks.